Good evening, all the joinees. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So thank you so much for joining in. So meanwhile others join, what we will really do is introduce our topic for today's webinar. Today, we will be focusing our discussion on comparing performances of mutual funds with their respective benchmark indices. Typically, in this analysis, first of all, we will see what are the multiple ways that we can use to onboard multiple schemes on engine markets, right? So there are a couple of ways of doing that. So I'll show you all of them as to how you can take a list of funds in the compare section on engine markets. Once we have a list of funds, we will then understand how we can analyze different parameters like value at risk, that is VAR, beta, correlations, among other things. These typically are the ratios which are to be always seen with respect to typically beta and correlations, always with respect to the benchmark, right? So we will understand how we can add in a benchmark which is relevant to that particular category that we are analyzing and then do this analysis. Post that, we will then go ahead and screening of mutual funds basis the capture ratios of these, right? So capture ratios up and down both. These ratios were introduced in the compare section very, very recently. So we now have these ratios for a list of funds to compare a list of funds right in the compare section. And then because they are in the compare section, of course, you can customize the start and end dates and see how these ratios change. So we will see how you can do that. Next, we will move ahead and understand how we can compare monthly SIP versus a lump sum analysis, which is done using the point to point tab on the compare section. We will see how these two measure up with each other. And then finally, as is customary, we'll throw the forum open for a Q&A session wherein you can get your questions answered by either typing in the chat box or directly unmuting yourself to speak. So let us now begin. So let me go on engine markets. Just a minute. Okay, so this is the engine markets platform. For the webinar related discussion, we will be focusing on the funds in the compare section today. So first of all, let's choose a category that we are going to analyze today. So let's consider small cap as a category. To check in all the funds from the small cap as a category, you need to go to the funds section and from these filter categories option, choose small caps. Simply click on filter categories and choose in small cap funds. So there are, you'll see into bracket 27. That means there are 27 small cap funds that are trading in the Indian equity markets right now. You check this box and all the 27 funds load here. So one second. Yeah. So these are all the 27 small cap funds. Once all of these list of funds get loaded here, we can then actually narrow down our search by putting in some basic non-negotiable filter parameters. By that, what do I really mean by that is, I mean, in this analysis, let's say you do not want to have very, very younger funds for analysis purpose. Then what you can do is you can go here, use our apply filters and put in basic non-negotiable filter parameters. Let's say you want to see funds which are at least 5 years or older. So you put minimum age as 5. And for this to take effect, you click on apply. The moment you will do that, now you will see only those funds which have been around for a period of 5 years. How will you verify this? So for that, you either scroll in using the scroller at the bottom, which will take you to age in years as a column. In this case, of course, you can sort this ascending descending order. You see the youngest fund in this case is a Canara Robeco small cap fund, 5.03 years old. And the oldest fund is a quant small cap fund, that's 27-year-old fund, right? All the younger funds have gotten removed. Next, what you can also put in is AUM as a parameter. So let's say we want to consider a minimum AUM as 2,500 for the universe that we are analyzing today. And then you click on apply again, right? Again, the universe has gotten reduced to a 16 funds. Now you see the trouble that we are facing here. We have to every time scroll on the right hand side and actually check whether this has actually taken into effect. And that is exactly the reason we have given multiple column views. So first of all, by default, what comes in is the all columns view, which typically takes into consideration every column that is there in this view and that shows up. But these typically become not really relevant columns for analyzing any small cap funds, right? Therefore, we have given this drop down. You can choose only equity columns. right? So the moment you do that, all the net YTM, all the, credit rated securities, AA rated, AAA rated, all of that will go away. And all the equity securities relevant columns will show up. Of course, you can pick and choose basic columns as well. So when you choose basic column view, you will see only basic columns like AUM, total expense ratio, the Sharpe ratio, standard deviation, month to date, year to date, the basic return parameters, and of course, age in years. So that is what gets visible. Okay, there is a message in the chat box which says, is my voice clearly audible? Um,
Yes.
yeah, okay, okay. So I would request you to please check the audio settings at your end. It is audible to the other participants. This is for Mr. Paul. Thanks. Okay, so once this is through, now what we need to focus on is the parameters that you can see here. For an example, all the parameters that you can see, the Sharpe ratio, the standard deviation, everything is since inception of these respective funds. For an example, this quant is the oldest fund in small cap as a category, right? Now, the Sharpe ratio number that you will see beside quant is going to be 27 years, since the last 27 years, right? On the other hand, we have a Canada Robeco, which is just about a 5 years old, and the Sharpe ratio for that is going to be 5 years Sharpe ratio. Now, this does not really become a fair comparison to analyze these funds. And that is exactly the reason we take all of these funds in the compare section so that we can put in a common start point for further analysis of these funds, right? To take them to the compare section, what you can do is you can use this toggle button at top 50 to compare. In one single shot, all these funds will get added in the compare section, up to 50, of course. In this case, we have only 16. So the moment I click on this, all the 16 funds are going to get added in the compare section. Once they come here in the compare section, the number one thing that you will do is set in a common start date. Okay, so let's, for an example, consider 3-year period for which we are doing this entire analysis for. So 3 years means typically 2021. So I choose 1st of February 2021 in the settings wheel column that you can see here, and I click on go. It will show up an exclamation mark in red. That simply means, okay, you have chosen in a custom start date, and these returns are since that particular start date. The first thing that you'll notice here is cumulative return, right? Before choosing in a start date, this was a blank column. Now, what does this cumulative return column mean? This gives you an absolute return for the time period that you have chosen in the start date. Meaning from 1st of February 2021 till date, meaning till yesterday, that's 22nd of February 2024, the absolute returns of all of these funds. And you can, of course, sort this in ascending descending manner. In this case, we can see the highest return in this time period of last 3 years has been given by a quant small cap fund. That's 232% return in the last 3 years. On the other hand, in this case, the lowest return is by Aditya Birla Sun Life small cap fund. Cumulative or absolute return is a 98%. Okay, this is cumulative or the absolute return. Now let's go on to some other ratios. For an example, Sharpe ratio in this case. We sort this on the basis of ascending descending order. We see Nippon India performing the best when it comes to the Sharpe ratio. Now, what does Sharpe ratio indicate? Sharpe ratio per se gives you returns that each of these funds generate per unit of risk that they take. Now, for risk, Sharpe ratio considers denominator as the standard deviation, right? Which appears here. That is the measure of volatility of each of these funds. So higher the Sharpe ratio, the better it is. So the more you have returns per unit of risk, it is a good thing about that particular fund, right? So if it is a higher fund that actually reports a higher Sharpe ratio than some other, the fund is a better performing fund. Now, in this case, of course, we are doing a peers comparison, but in order to add in a flavor of a benchmark here, let's do one thing. Let's go here at the top and add in a benchmark for these small cap category. So because these are small cap funds, I will add in a Nifty small cap 250 as a benchmark. I just need to search here, and this benchmark gets added here as a row item. Nifty small cap 250 is right there. Now again, this is a 3-year analysis. Let's sort this on the basis of Sharpe ratio. We see these are the funds, all of these funds typically, right? Till SBI, all of these funds have reported a Sharpe ratio that is much higher than the benchmark itself, right? Our benchmark Sharpe ratio is 1.35. all the funds that appear at the above this have outperformed the benchmark when it comes to Sharpe ratio. On the other hand, Aditya Birla Sun Life Small Cap Fund, which is just one fund in this small cap list of 16 funds, it has a Sharpe of less than the benchmark. That means it has not outperformed the benchmark returns. Right now, of course, this was for Sharpe ratio. You can replicate this for standard deviation for that matter to actually come up with a fund in small cap as a category which is least volatile. In this case, that happens to be a Kotak small cap fund because its volatility or standard deviation is the lowest. Look where the benchmark standard deviation is. So the benchmark is right here, second last. Its standard deviation is a 17.35. We have one fund, which is Quant, that has a volatility number that is even higher than the benchmark itself. That means a quick conclusion here is the riskiest fund in small cap as a category, which is even not just risky than its peers, but even riskier than the benchmark itself, is a Quant small cap fund. Of course, by taking in addition this extra risk, it is definitely beating the entire lot of the small cap by generating the highest return in the category, and that is exactly what we saw just before this. Cumulative returns was the highest for this particular fund, right? Now this was Sharpe ratio and of course standard deviation. Now let's come to value at risk, or VAR, as a parameter that you can see here. Now VAR typically is of course an abbreviated form for value that is invested in a particular fund that is at risk. At risk of what? At risk of losing. Okay, so meaning if we were to understand this in a little bit better manner, if we say that if 100 rupees is what I invest in each of these funds, okay, every fund that I have in this list, all 16 funds, if I invest 100 rupees in every fund, and if I consider a 95% as my confidence interval, so this is a statistical ratio, so we need to attach a confidence interval to it. So if we consider 95% as a confidence interval, and if history were to repeat, there are 5% chances that Kotak, in case of Kotak, my capital erosion will be 20 rupees out of that 100 rupees. On the other hand, if I put that same 100 rupees in this Quant fund, my capital erosion would be 33 rupees out of 100. So that typically, again, is an indicator of how risky is a fund, right? That is exactly what value at risk as a parameter tells you. Of course, this is comparing for a list of funds. Of course, you can compare it with the benchmark here as well. So again, it gives us similar results. All the other funds that you can see in this list have value at risk number that is pretty much less than the benchmark itself. Benchmark is at 31.24% value at risk number. All the other funds, other than of course Quant, reports lesser value at risk number, but Quant is at a value at risk of a 33%. Right. So that is value at risk as a parameter. Next, let's come on to some ratios which are always calculated only when they're compared to a benchmark, like beta or correlations for that matter. To actually see these ratios, you'll have to use this scroller that you can see at the bottom, and using the scroller you have to move on the right hand side. The moment you start moving on the right hand side, you will see the green color coded columns end at 15-year return, and of course you will not see 5-year, 7-year, 10-year returns. That's because in the custom start period we've just taken a 3-year period. Right? The moment you scroll on the right hand side, you will see some pink color coded columns here. These are the columns that are always calculated, or these are the ratios that are always calculated when we have a benchmark yardstick in front of us. Right? Only then that can these ratios be calculated. As of now, we have not chosen any benchmark, and that is exactly what is this red message telling you. This is disabled, and you, in order to turn this on, you need to check box the relative columns. The moment you check this on, you will see a benchmark appearing here, and all of these ratios start coming in. Of course, this is a Nifty 50 in this case. This is not really relevant for this list because we have small caps. So I just do backspace and I choose again a relevant benchmark. Again, a Nifty small cap 250. The moment I add in a benchmark here, now the number one thing again that you need to remember is, in order to make a apples to apple fair comparison, we need to ensure that the start dates at both places are similar. For returns, look what start date we have considered. For this Sharpe ratio number, standard deviation, everything we were doing for the last 3 years. 1st February 2021. Therefore, when we are starting to compare these with the benchmark, we have to ensure that the start date for the benchmark, which is Nifty Small Cap 250, is also February of 2021. So what I do is using this date drop down, I choose 1st of February 2021. And now this is a fair apples to apples comparison. Now these pink color coded columns give you all the return numbers of all the ratios when calculated in consideration of this particular benchmark, again for the last 3 years. Now let me sort this on the basis of annual excess. Let's understand first what annual excess as a parameter mean. This is nothing but tells you on an annualized basis what is the excess return that is generated by each and every fund that is listed on the left hand side over the benchmark's return. In this case, you will see Nifty Small Cap 250, there's a dash. Why? Because there's no excess return. We're comparing the same benchmark with itself. So there's no excess return, this dash. On the other hand, all the funds that appear here above the benchmark line given a positive annual excess. Mind you, this is annualized excess. If you want to check the cumulative or the entire 3-year excess, that's right here, cumulative excess return over that of the benchmark, right? So that's, in other words, this is kind of a modified alpha that we are seeing here. Okay. Next, the second parameter that we can consider while comparing the performance of mutual funds against that of the benchmark is, of course, the beta. Now, beta as a measure, and how is that different from standard deviation, is standard deviation does not require a benchmark to calculate itself. So this is simply volatility of the fund, and this is an independent parameter. On the other hand, benchmark, when we calculate it with terms of the benchmark, it comes in the form of beta, meaning we understand how risky is the fund when we compare it with the risk of the benchmark itself, right? So we are using benchmark as a yardstick to measure the risk of all of these funds. Now, what is the common parallels here? A beta of 1 is always assumed to be the market risk. So in this case, Nifty Small Cap 250, which in this case is our market, has a beta of 1. Right? Now, if we have a fund that has or that reports a beta that is less than 1, that typically means the risk of that fund is lesser than that of the benchmark itself. On the other hand, if we have a fund which has a beta of 1 or more than 1, that typically says that its risk is higher than that of the benchmark. In this case, apparently, we can see right here, Quant, as we were just discussing, it is one among the riskiest fund in the small cap as a category, and it has in fact reported a beta of 1, which typically means with similar risk of that of the benchmark, it generates a excess return. And that is exactly what is indicated here. On the other hand, we have some of other funds which definitely generate positive alpha over the benchmark. That's Nippon, HSBC, HDFC, Tata, and so on. But they do that by taking in lesser risk as compared to the benchmark. Look at that. The beta numbers are less than 1, 0.83, 0.82, 0.81, 0.71, and so on, right? So if there's a fund which generates excess return or a positive excess return as compared to the benchmark by taking in lesser risk, that's definitely desirable, typically for a client who is slightly on a moderate or a conservative side, but still wants to go into small cap, right? So this is something that, this is one analysis that you can definitely look. Once we are done with beta as a parameter, let's now come across up capture and the down capture ratios, and let's see how we can use this to actually screen mutual funds, right? So in this case, you will see these up capture and down capture ratios right here in the relative columns. Again, because they are appearing here, it's fairly obvious that they can be calculated only when we have a yardstick of a benchmark to calculate this. Let's first understand what up capture and down capture ratio mean. To understand this in a little better manner, I'm going to simply open a new fund, open a fund in a new tab, and then show that to you, right? Let's simply load in Nippon India Small Cap in a new tab. It opens up here. Let's again put in a start date, which is similar to what we were doing in the compare section. So 1st of February 2021, and I click on run. So now this is again a 3-year analysis that we're doing. And scrolling down, let's come to up capture and the down capture ratio. So here, click on the I button that you can see beside the up capture and the down capture ratio. Now this is going to, up capture ratio typically is going to give you a trend month on month when the benchmark gave in positive returns. It is going to capture only those months when the benchmark, the fund's benchmark, in this case, it is Nifty Small Cap 250, has clocked in positive returns. For an example, in February 2021, the benchmark return was a positive 9.68% in one single month, by the way, right? And in the same month, the fund, which is in this case Nippon, has given in a positive return of a 10.63%. Okay. And in this case, of course, in this month, it has outperformed the return of the benchmark itself. On the other hand, as we keep on scrolling down, we'll see in October 2021, this was such a month when the fund's return was negative, but the benchmark actually gave positive returns. Now you will note here that we will consider only those months when the benchmark has given in positive returns, and that's why we call this as a bull run, right? When the benchmark is in a bullish trend, what is the catch up that the fund is doing with that of the benchmark returns? And that's why we call this as a up capture ratio. When the benchmark is up, how much does the fund catch up, right? If you cumulate all of this up, that comes to a summation of a 79% up move given by the fund, when the benchmark, on the other hand, gives a up move over 85%, almost 85%, right? So that's if we consider only in a bullish trend or a bullish market, the fund has not been able to outperform the benchmark. And that is exactly the reason you will see up capture less than 100. That means if benchmark goes up 100 times, the fund is going to go up 94 times. This is what up capture ratio tells you. This is calculated by taking this ratio. So 79 divided by 84.54, that's a 94. So what is desirable is higher the up capture ratio is definitely going to be more desirable, right? Exactly converse is the logic of down capture ratio. Down capture ratio tells you how resilient is your fund when the benchmark is going down, or the benchmark is in a volatile time or a bearish trend, for an example, right? So for that, you simply click on this I button again, and you will see only those months will be captured here. Of course, from the start date that we've considered. So from February of 2021 till 2024, only those months will be captured when benchmark actually gave a negative return. Now, this is going to be irrespective of the fact whether the fund's return was positive or not during that time. Okay, because what is our yardstick is the benchmark, right? So for an example, in November 2021, so you'll ask, why is this month captured? That's because benchmark gave a negative return that time, right? Therefore, this will be termed as a bearish market. So when in November 2021, when benchmark was down by 0.24, our fund gave in positive 1.80% return. And that's definitely a good thing. And if you cumulate all of this up, that comes to a down move by the fund by a 17%. On the other hand, at the same time, in the same time period, the benchmark goes down by a negative 33%. So our fund's resilience to down markets or when the benchmark is in volatile times is much better. And therefore, you will see a down capture ratio of 53. How is that achieved? So 17 divided by 33, that's 53. Which in other words can also be interpreted as if the benchmark goes down by 100 or 100 times, your fund goes down by 53, right? So lower the down capture ratio is going to be the more desirable one if you're looking at a better resilience, right? Now let's come back to this list. Once this logic of up capture and down capture ratio is clear, let's sort this on the basis of, we know now that higher the up capture ratio is, the better thing, right? So let's sort this on the basis of high to low. In this case, look at that. The fund which has the highest up capture as compared to the benchmark is a quant small cap fund, right? In fact, that is the only fund which has a higher up capture ratio when we compare that with the benchmark itself. All the other funds definitely go up in the uptrend when the markets are in a bullish trend, but definitely go up lesser than the benchmark itself. There's only one fund that beats the benchmark in bullish market, which is quant small cap, right? On the other hand, let's look at the down capture ratio. Let's sort this on the basis of, now we know that for a fact that down capture ratio, lower the better. Okay, so in this case, Axis small cap. In this case, Axis small cap as a fund is the most resilient small cap fund, which typically says that if benchmarks are going down, or for that matter, Nifty small cap 250 index is going down, it will definitely go down, but will go down the least among its list of peers, right? So now this becomes a good decision-making tool only on the basis of looking at up capture and down capture. Let's say a client comes to you and he says that, okay, I want to invest into small cap as a category. But then further you ask him, okay, what typically is his investment style? Is he an aggressive investor? If he's an aggressive investor, you would not mind, recommending him a quant small cap, or for that matter, a Nippon or HDFC, right? Typically because they have higher up capture ratios. On the other hand, if he says, okay, his investment style is more, lopsided on a conservative or a moderate level, but he still wants to go ahead and invest into small caps, then better funds for him could be a Axis or a Franklin or a HSBC. Why? Because for the simple reason, when the markets fall, they fall lesser, right? So you can just use these two ratios to actually come up with definitive conclusions for your clients. That's the use of up and down capture ratios. Now let's move on to further part of the discussion, wherein we'll be discussing monthly SIP and point to point. So for monthly SIP, one second. So for monthly SIP, let's move on to this tab in the compare section, which is monthly SIP tab. Here, this is a simulator that you can run. You can put in an installment amount of your choice once you've come up with the list of funds. So for an example, you have, okay, Axis for conservative and for a quant for a aggressive investor, right? Now you want to decide whether he wants to, or whether he should do a SIP or a lump sum, right? So you go to this lump sum, first of all, monthly SIP tab. You put in an installment amount. So let's say it's a 15,000 invested monthly. Again, let's say for a period of 3 years, let's keep that consistent in this analysis. So 1st February 2021 to 22nd of February 2024, and you click on Run SIP. Let's sort this on the basis of descending order, meaning highest to lowest XIRRs. If we consider that, of course, because it's a XIRR, the highest return in this case is generated by quant small cap, and that is exactly what is visible here, right? So if it goes on the extreme aggressive side of it, the best return is, of course, given by a quant small cap fund. The corpus, 15,000 invested every single month, become a 10 lakh 20,000 rupees. If you want to run a detailed SIP analysis, all you need to do is simply click on this piggy bank icon. It will load up in a new tab and it will show you the installment. I mean, 15,000 invested monthly in this 3 months period. That is an installment of total 37 installments. 5,55,000 is the invested amount, and that becomes a 10,20,000 rupees. Again, all of this analysis, once all of this analysis is done, we have given you 2 reporting options in PDF manner. You can just download this detailed 2-3 pager PDF. It will get downloaded like this, and of course, it will have your organization's logo and name, right? This is how the detailed NAV or a SIP analysis looks like. So number of installments, total invested amount, final value, and of course, month on month, as the installments keep on coming in, what is the value of your portfolio and how does it change? This is what is given in the SIP tab. Now let us interpret this chart that you can see, the graph that you can see here. Again, this is same analysis that you can see here, but of course, because it's in a graphical manner, could be a little complex to understand. So let's first understand this green thing that you can see here. So this is a step up. This is basically, how as month on month, as the installments keep on coming in. So it's a linear increase in the value of your portfolio, invested value of your portfolio. So you started with 15,000. The next installment came in, your portfolio became a 30,000 invested portfolio, right? After a while, it becomes a 60,000 invested portfolio, and so on and so forth. Linear increase in the investment till, of course, the end date, that is 22nd of February. So that's a 5,55,000 investment, right? Now, the orange line chart that you can see, and please see this considering y-axis on the right-hand side, right? So y-axis, there are 2 y-axis. Focus on the y-axis that appears here on the right-hand side, which is a level which maps the NAV of the particular fund. So in this case, it's a quant small cap fund. When you put in the first installment of your SIP, the NAV was 72 rupees, 72.81. And that is exactly what is also visible in this tabulated manner, right? So this was the NAV of the fund. As your SIP kept on moving in, the NAVs, of course, kept on changing. And today, when you're trying to look at this analysis, the NAV today is a 241 rupees. Today, that's 22nd of February NAV, right? So from a 72 rupees, the NAV has increased to a 241 rupees. Okay. Now, because of this increase in the NAV, of course, your portfolio is going to portfolio value is going to increase, right? Your portfolio invested value has increased in a linear manner, but your portfolio actual current value will, of course, depend upon the NAV tops and the bottoms, right? And that is exactly what is indicated in this blue area that you can see here. Okay, this is how your portfolio value is increased, right? If there is a drop in the NAV of the fund, you will see a drop in the portfolio value also. So this will move in tandem with the orange line that you can see here, right? So if you just hover on this, it will typically tell you 10,20,000, which is your final value. And typically, if you want to see the profit, or for that matter, surplus of your portfolio, that is exactly this part. One second. Whatever you can see above this green line and this blue part is your surplus of your portfolio. That's your return. That's 43% return. This is exactly that. So this is how you interpret this graph right here. And now this was, of course, monthly SIP analysis. Let's come to now point to point, which will help us in understanding how a lump sum investment would do over a time period. So for that, let's move on to this point to point tab in the compare section again. Here, what you will see is there are 5 different scenarios, or for that matter, time periods or buckets that will be given to you. Again, the start dates in these buckets are customizable, right? You put in dates of your choice and run this analysis to check how a lump sum investment of XYZ amount would do on each of these funds across different time periods. So this is like a modified what if or a scenario analysis that we can do here. Okay, for an example, I have put in a lump sum investment amount of 10 lakh rupees. If I would have put in 10 lakh rupees, let's say on 1st of January 2014, and held on to it till 31st of January 2024, what would have been the status of my 10 lakh rupees? So I simply sort this on the basis of descending order, and I see this 10 lakh rupees would have become a 1.16 CR rupees in Nippon India Small Cap. In fact, this happens to be the best performing fund if we consider 10 years as a time period, right? From, of course, 2014 to 2024 of January. If you want to see this in typically percentage terms, of course, there's a toggle that will help you do that. So this is, of course, in rupee terms. If you want to see this in percentage terms and that to CAGR, you simply use this toggle and this will get converted into percentage terms. Again, sorting is available. If you want to see actual absolute return, meaning the cumulative 10-year return, then use this absolute toggle and you can actually check this in percentage terms, but for absolute returns. Now, if you want to have a graphical representation of whatever you're seeing on your screen right now to maybe, let's say, include in your reports, then what you can simply do is click on this show comparison chart icon that is appearing right beside sort icon. The moment you click on this, it is going to show up bars and it will show you, of course, the percentages appearing at the top, meaning a graphical representation of it. A screenshot option is definitely enabled at the top. You can definitely click on this camera icon. This chart will get downloaded. Because we have active selection on absolute, this is showing us absolute returns. But of course, if we change this to, let's say, in rupee terms, you can do that. And let's sort this so that the graphs are pretty coordinated and you have it like that. Right? So sort this first and then click on that chart icon. You will see from top to bottom the list of funds that have given from highest, so 1.17 CR to 54.29, that is by Aditya Birla Sun Life Small Cap. So this was lump sum analysis on a particular scenario. Now, the beauty of this is you can create multiple scenarios. In this case, what I've considered is a 10-year scenario is the first bucket. My second bucket is typically a 5-year scenario. So if I consider a 5-year scenario and I invest 10 lakh rupees at the start of February 2019, what would it be in value terms, right? So Quant would have generated the highest return, right? 10 lakh would have become a 50 lakh rupees. On the other hand, now we have an upcoming election. What happened to the entire small cap as a category when there were elections last time around? That's general elections 2019. If you want to check a what if analysis on scenario last time general elections time, what you can do is just build in dates accordingly. So what I've taken is 1st January 2019 to 31st of July 2019. That's 3 months prior to the elections, 3 months post the election. And I'm going to sort this on the basis of ascending to descending, right? So in this case, we see Axis Small Cap generated the highest return. Of course, there's a 6-month period. So we are just having a look at the trend. So only these two funds, meaning Axis and IPRU, gave in positive returns. Everything else, actually, there was some erosion that happened in the capital, right? So these are the only two funds that gave in positive returns last time around, when there were elections last time around. Further, you can, of course, build in scenarios like, some black swan events happening. So this is like a COVID onset. When there was onset of COVID, this is just 3-4 months period that I've considered. Everything was in red, right? And rightly so. So in this case, which was the fund that fell the most? That was a HSBC small cap fund, which fell by almost a 60%. Right, in this time period. Of course, this was CGR. If you want to, because this is a lower time period, so you would rather prefer an absolute return percentage. So I switched to absolute, and then I sort this. We see HSBC actually experienced a loss of 26% in this time period of 4 months, and that is what is visible right here. If you want to check this in value terms, of course, you can switch. And of course, the last scenario is something that I've considered like a recovery from COVID. I mean, there was a recovery, and typically small cap space actually outperformed even the large cap and the mid cap space, right? So I've considered 2020 as a start date, June of 2020, and then end date is December 2022. That's meaning we had a war that happened. We had IT crash that had happened in this time period around. So lot of unique events, or events that we do not generally see happening in a quick span of 2 years, right? That is what I've built this scenario for, and we can check what was the performance of each of these funds. Now, the beauty of this tab is these dates will be saved, right? So once you've done the entire effort of what scenarios you want to show to your client, whichever list you load, these scenarios won't change, right? So once these scenarios set, let's say now I want to show this for mid cap funds, right? So let's say remove all of these small cap funds, and I want to, let's say, add all the mid cap funds. So what I do is, and I do not want to, let's say, sort this on the basis of, okay, 5 years younger, or, some XYZ AUM funds. I want all the mid-cap funds, right? So second way of onboarding all the funds, list of funds in the compare section is directly in the compare section itself, go to add groups and add SEBI category, entire SEBI category of mid-caps. So I'm just going to choose mid-caps. All the 29 funds in one single shot will get added in the compare section. But please mind, we have not put in any filter parameters. So there are no filtering out of younger funds. There's no filtering out on the basis of AUM. Everything, entire universe is right here. Okay. I just wanted to show you that even if you change the list, our scenarios, our start and end dates that we've built in the point to point have not gotten changed, right? So your effort gets saved, right? The moment you go to point, you have these scenarios ready. You want to check, okay, what happened to mid-cap universe this time around, right? So it's right there in front of you. That can be checked. So this was it for the topic-related webinar discussion from my side. If you have any questions, we can now throw the forum open for a Q&A session. You can please feel free to ask all of your questions by either unmuting yourself or typing in your questions in the chat box. Thank you so much.
Hello.
Yes.
Ma'am, my question is not related to today's webinar. Actually, my doubt is like, suppose if I go to the client section where we have existing clients, right?
Yeah.
Hello.
Yes,
Yeah.
you're audible.
And
Yes.
already their portfolio is made. And I want to add, want to test some of the funds I want to add. I would just want to see whether there's any overlap or not, and how to do that.
Okay, sure. So you're saying your portfolio is already added using this RTA connection, right?
Yeah.
Okay, done. Okay, so for an example, let's say this is your portfolio or this is your client portfolio. That's Shekhar Sharma. You'll not be able to do any editing here, but because this is directly linked to RTA. But there's a way about it. What you can do is simply copy this client to manual data tab. Okay, you can see this copy button. The moment you click on this, okay, so this name will come, Shekhar Sharma portfolio will come in the manual data tab, right? Go in the manual data tab, which is a tab right beside RTA connection. Search for it. So Shekhar Sharma, yeah, this is the one. Open this and you will see this edit portfolio. What you need to do is click on this edit. And let's say, for an example, you want to remove IDFC focused from this, right? Remove this. So this is about 9,40,000. Remove this and maybe add another fund you said, right? Maybe let's add a Axis mid cap. I'm just choosing any random fund. You add this here, you put in current value. I mean, whatever we change, we'll replace that with the same amount. So let's say 9,40,000 rupees. You just put in the amount, units it will automatically calculate, and then click on done. Once this is done, you click on run analytics. And then move on to overlaps tab. So you will have that one change that you've just incorporated in terms of Axis Midcap right here. So you can check overlaps. That's possible.
Now, what if I don't want to remove it? I just want to add, like, suppose somebody wants to give more investment to me. Suppose he wants to give me 5 lakh and I want to test whether this fund is good or that some other fund is good. I want to just test, where I should go so that overlap is not being done. For that, I need help, like, is it possible?
Yeah. Typically, I mean, I just deleted one for just an example's sake. What you could do is simply add one, right? Instead of deleting. So that's possible. I mean, you can make changes. What my point was, you cannot make changes here in the RTA tab. You will have to copy that in the manual data tab, and then you can make any changes.
What is the procedure? First, I'll go to manual data.
Okay, look, first you will load the
Yeah.
client. Okay, let's say this is
Yeah.
Pranav Dalal's portfolio. You want to edit this. Okay, here in the RTA connection, you will not be able to edit. So you click here, copy this client to manual data. This is the first step. Load the client, copy it.
To manual data.
Copy it. I will copy this. It will say, okay, done. Check this in manual data. Then I move here in the manual data tab. This is right there in the client section only, beside RTA connection tab. Okay, you go here in manual data. You search for the client. It was Pranav Dalal. You load this. You'll see now edit this portfolio option enabled. You click on this. You add whichever fund you want, and now run this as a test again, right? Okay.
Hi, this is Arnab. One thing to mention here is that the manual data tab is another list which you can maintain on your own. You can make any changes there if you like. Your RTA connection tab will always remain connected to your RTA data, so you can't make any changes. So as soon as you copy that portfolio to the manual data tab, it's a copy, so it's in a whole new different client list basically.
Okay.
So you can do whatever you want in this manual data tab. You can add your clients here on your own.
If an investor, he's in some other broker's code, and if I want to, can I copy his data into this?
Yes, of course. So if you either have in the manual data tab, you can basically add a new client, right? From scratch, basically. So you can add the portfolio that they have with a different broker on here, and you can even compare them with what you have versus what they have. So this manual data tab is a completely open section where you can add your own data however you like, and you have to delete it and you have to manage the data on your own. So
How
it's
to do that? Can you please again? From somebody
Prajakta,
outside
yes.
my RTA.
Yeah.
Sure. Okay, so you want to understand how you can onboard a client in this manual data tab, right?
Yeah, from outside, yeah.
Yeah, sure. So there are two ways of doing that, rather three ways of doing that. So firstly, you can key in the holdings of the client manually, right? You click on add client manually, put in the name and go on adding the schemes that he holds. That's one way. That's fairly time consuming, taxing way. The second way is directly using the statement analyzer tool.
How do I add, like, to write the fund name, the value, and then NAV and all that? Everything I have to do manually? How to do that?
Just one way of doing that. Yeah. So I've clicked on add client manually. I put in a name. Okay. So this is test 100. This is the name of the client. I click on add client. Then whichever funds you want to add, you can add it right there. Okay, just type in the name of the fund. Let's say anything. I mean, okay, so I approve blue chip. The moment you add in the fund, you either put in units or you put in current value. The other field will automatically get captured. For an example, I know for a fact that's 1000 units of I approve blue chip. You put in units, current value will automatically get captured. We can add as many funds you want. This is the manual data entry option, right? Let's say it's a 2-fund portfolio. Okay, that's how you do it. And this is the only portfolio that I want to create. And I click on done. This portfolio will be created in this manual data tab only. The moment you click on run analytics, the entire detailed portfolio analytics will run on this particular portfolio. That's one way. The second way is using this statement analyzer tool. Now, what statement analyzer tool does is it lets you onboard a prospective client's holdings from his NSDL, CDSL, or CAMS ECAS statement. Okay, we will need a ECAS statement of your client for this. Okay, this is a password protected statement. You simply click on choose file. You choose the file from your system. You put in the file password and click on check file. The moment you do that, it will appear here on the right hand side. The holdings from his file will be captured like this. Once you have it here on the right hand side, go back. Now, because you're going to add it from statement analyzer, choose this add client from statement analyzer. Click on this. You will see a list of all the clients whose ECAS statements you have onboarded, right? You click on load holdings from this file. Oh, 1 second. Yeah. So you click on add client from statement analyzer. You click on this load holdings from this file.
बगीचे में मंगवा लीजिए गार्ड से बगीचे में है
Yeah, so that's how you can onboard a prospective using ECAS, right? His holdings are onboarded, and then you can, of course, run analytics. The third and the last way to onboard a client prospective client portfolio is using this portfolios tab, wherein if you have in an Excel sheet just 2 columns, one column would be ISIN numbers of the mutual funds or stocks, and the other column could be either of percentage or amount or units. Okay, let's say we have ISIN numbers in one column, and in another column we have the units that are there for respective ISIN code, right? You copy that from Excel to this gray portion on NGEN Markets. You then ask the system to read these as whatever it is. So in this case, it's units, and then click on validate input. The moment you will do that, this will get converted into names of the funds, and this will be the into percentage. The units will get converted into percentage terms. You can name this portfolio and then click on create. Right? That's how. That's the third way of onboarding a completely new prospective client, which does not invest through your RIA code or ARN number. Right? These are the 3 ways of portfolio onboarding onto NGEN Markets.
Prajakta,
Yeah.
can we upload that PDF which normally new client receive from their own broker or maybe MFD? Because everybody has their own format of sending reports. Some don't capture even ISN over there. Most of them don't capture the ISN.
Okay.
Normally it is in PDF format or Excel format.
Got it. No, so as of now, the 3 recognized PDF formats are these only. So we capture only, rather our tool is optimized to capture only these 3 formats, ECAS statements, NSDL, CDSL, or CAMS. Or if it's Excel, then, I mean, as an identifier, we need the ISIN number as of now, at least.
Okay, so other way is to that you convert that PDF into Excel and then.
Yeah. You can scrape out, of course, that is there, yes.
And there are no extra charges for doing this, no? Like from outsider getting into this.
Sorry.
No,
I don't
are there
understand
any
your
No,
extra
no,
question.
charges?
there are no charges. You can input anything you want. Once you have a premium logging, after that everything is there.
I want help another like webinar like from the very beginning because I've not understood all the tabs. So can
No
I
problem. You can, yeah, we can give you a full training session. If you just write us an email at support@ngenresearch.com, we will schedule a training session with you and someone will take you through all of the functionality or anything specific. You can do that as many times as you want.
okay, I'll drop an email, yeah.
Uh,
Perfect, perfect.
Prajakta, hi, this is Vikas. Am I audible?
Yes, yes. Please go ahead.
Prajakta, my question pertains to the international funds review. Can you please run through the same ones?
Okay. So by international funds, do you mean FOFs overseas?
Yeah, global.
Yeah, yeah. Okay. So typically we have a separate tab for fund of funds, and that's right there. So you can typically choose these, and then all the funds from these categories will load up. 1 second. Of course, in this case, we've put in these parameters. These are the funds. I mean, you want me to load one particular fund and then
You
open.
can pick
Yeah,
any fund.
yeah, sure.
Yeah. So the question that I have here,
Yes.
that by default, it creates a lot of confusion when we do the research on the software, because by default it takes the Nifty TRI as a benchmark, which puts the whole ranking and everything. It's not correct actually. And I have noticed this multiple times with few of the generic funds also. So my feedback, if you're not doing it right now, my feedback is, so it completely, the whole research has no meaning if the benchmark is incorrect, right?
Sure. So the approach that we've generally taken is that we generally but we let the user choose whatever benchmark they want to choose. We don't, generally speaking, load the benchmark that the fund manager has provided.
Arnab,
And
that's what my
yeah,
feedback is. That's what my
yeah,
feedback is, because there are multiple benchmarks, and as a user of the software,
yeah,
this is
yeah.
that we by default would expect, because I asked my team to do the review, and when I saw
Mm-hmm.
the of the funds, I could immediately realize that there is some gap. When I opened,
Right.
I could see that okay, the benchmark is taken wrongly here. So
Yeah, yeah.
you can understand that at least every time, even there are multiple funds in this category itself now,
Of
and
course, yes.
greater allocation is going to the international side. I would
Mm-hmm.
suggest that we start taking the benchmark. I don't think so it's going to be that difficult a task, and in fact that's applicable to, because when we are doing the portfolio review, it's
Mm-hmm.
good who are giving us the opportunity to pick up the benchmark, because that actually helps us to pick the benchmark basis the asset allocation, right?
Right. Mm.
But when we are doing the comparative study of the funds, if the
Yeah.
comparative study is not on the basis of correct benchmark, the study has no meaning.
Well, the issue, I agree. But the issue that we have is, what is the correct benchmark? That's the entire problem.
So the
Now, if
correct
we
benchmark
listen
is,
to the,
yeah, the
if
current
we listen to the fund
benchmark is
manager,
fund house, sir.
sorry.
I said the current benchmark, the correct benchmark is given by the fund house. So it
Yeah,
is
see, that's the problem,
everything.
right? That itself is the problem because the fund manager himself is saying you benchmark me with this, right? So if we want to do an independent analysis, we can't ask the person providing the return what benchmark to use. Now,
No, no, no,
I know that there are a lot of systems are
no, Mr.
doing this, but
Mukherjee.
the thing is,
No, 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 no,
uh,
no. It is not. It
yeah,
is not coming from the asset management background. It is not at the discretion of the fund manager to pick the benchmark. It is as per the
right.
defined guidelines. We cannot put any benchmark for
Of
the
course, of course. Yeah,
comfort.
it has to make
Yeah.
sense that I
Yes, yes,
understand.
yes.
So for example, here you can see the benchmark. We actually show the benchmark that they've chosen. It's MSCI, right?
Hmm.
Now the second problem that we have is MSCI data is very hard to get. I mean, we're definitely not publicly available, and it's
Okay.
extremely expensive to purchase. So
Hmm.
what we have to do is use some kind of proxy for it, right?
Okay.
Now So I get your point that you want to actually see the kind of fund manager declared benchmark load by default. And what we have done so far is that in funds where the benchmark that the fund manager has declared is available, um, in that case, those benchmarks actually load. But the issue is obviously every fund house is kind of picking their own. I mean, for example, you can take large cap funds. One large cap fund will have one benchmark, the other large cap fund will have another benchmark, and that happens, right? I mean, technically speaking, there is no reason for one large cap fund to have a different benchmark from the another large cap fund. I can understand a large cap fund will have a different benchmark from a small cap fund, but two large cap funds should not have different benchmarks, right? So we run into issues like that.
I don't. I think that possibly could be an issue 3 years back, but in large cap category now the SEBI have clearly mandated as to where the benchmark should be, with
Right.
the clear cut demarcation and the categorization. Now you will not find enough issues happening.
Sorry to interrupt, but so it's right there. So iPro Blue Chip, it's a large cap fund. It takes, the fund manager has declared Nifty 100 as the benchmark, and I've loaded simultaneously a Bandhan large cap fund. It has S&P BSE 500, which is declared, by the way. But on the other hand, NGEN by default loads for both the funds Nifty 100. So we have tried to maintain.
The point here is, I can understand where you're coming from. The point here is, and you would have taken the message rightly. If the large cap is differentiating the benchmark, and we are default for a large cap category as a software provider, you can choose that Nifty 100 possibly is the right benchmark to choose from. What is happening with the international funds is that international fund benchmark is nowhere in the match. So they
I agree. Yes.
It's a fundamental issue.
So what we have actually been doing now, we've started the work for it also, is that we've had these issues with basically the categorization, SEBI categorization. So for example, if you look on the screener and you look at ETFs, for example, there's all kinds. And the classification, inside there, you can see 139 of them. Some are doing something, some are doing something completely different. But they are in the same SEBI category. So what we are introducing, well, hopefully soon, is going to be a separate classification that we do, right? And we'll let users choose if they want to use the SEBI classification or you want to use the NGEN classification. And the NGEN classification, once it's in place, what we will do is we will say that we feel that large cap funds should have this benchmark. We feel that small cap funds should have this benchmark. So depending on which NGEN classification the fund falls in, we will provide a relevant benchmark. Obviously, we'll take feedback from our users also about what should be the correct benchmark for this kind of ETF, what should be the correct benchmark for a small cap fund. So and build it that way, because right now what's happening is, if you load any fund here, like just click on an ETF right now, right? Just click on an ETF right now. I don't even know what will come up here. So this one is probably easier because Nifty mid cap 150. That's probably not hard to find. But what happens is the list of benchmarks that we have to gather data for is just exponentially increases. Every time a new fund is added, they are saying my benchmark is that now. So we have to go find that data. And, unfortunately, index data, you saw, everything from a simple Nifty 50 data, which is obviously here, all the way to MSCI, that, we're starting to cover the whole world now. So getting the benchmark data is becoming harder and harder. So what we will do is try to put these in classifications and then apply a benchmark to that. So we'll try and solve the problem. I understand the issue you're having, because obviously when we load that the overseas fund, there's no there is no common sense in having Nifty as a benchmark.
Right now, I had to ask my team not to do comparative study using NGEN for the international funds.
Right.
So
understand.
We would request you if you can kind of make it more meaningful. I have
of course.
I have second issue also, which I realized when I'm using it. Prajakta, can you help me out, since it's your screen? Can you help me out to run with the ELSS comparison, please?
Sure.
Can pick any fund.
Okay.
All right. Can you come down, please, on the Sharpe and Sortino?
Yes.
All right. And can you pick some other fund also? Any other fund.
ELSs only, right?
Any ELSs, yeah.
Yeah.
Again to the sharpest Sortino.
Yes.
If you see and compare it right now, we are taking the same benchmark, but on both the funds. In fact, it is happening with all the funds also. Check the benchmark Sortino Sharpe, this fund and the other fund that we've picked up, Motilal.
Yeah. I'll tell you why this
Time
is.
period.
Yeah. So basically DSP ELSs, the moment I load it, it starts, analysis from 2010, right? The start date is the one that is causing a issue. There's not an issue. So basically, the only thing that you have to ensure is the common start period is chosen. In this case, I've chosen a 3-year period for DSP ELSs. Go here in Motilal, again change it, right, to a 3-year period. Now that we've ensured it's the common start, one second, let me check. Yeah, so it's 18th Feb to 22nd of Feb for both. Go here and check the Sharpe ratios. It is going to match. Sharpe ratio for this benchmark is 0.70, 0.86. Sharpe and Sortino, 0.70, 0.86. It has to match.
Okay. All right. So
I was
under the impression that you were taking the Sortino basis the time period of the analysis that we are doing actually. So here what I understand that it is since inception.
Yeah. So by default, you can also change that. So when you load this fund, the default start date was 2010. Why? Because in your platform settings, the default start date when you load any fund is set as 2010. You can change it. But because this DSP fund was, launched in 2010, therefore 2006, it took 2010 as a start date. But what happened when we loaded in Motilal Oswal was it started only in 2014. So the default start date, when you click on that and open it in a new tab, it took something else, 2015, which happened to be its date when started trading. Right, that's why you see this difference. That's it. What you can do is to verify, to ensure this is
the point that I had that since the time period chosen, when we are doing this, can you go back to the sheet? Yes, when we take out the printout and broadly we take a MTD, YTD, 1 year, 3 year, 5 year period. By default I was under the impression, and that is how it looks like, that the sharpest Sortino is picked on the basis of the return that we are reflecting, not on the basis of the the inception date.
In this case, you can change the start date, but there's a better way of doing it, because in the screener, if you just add 2 or 3 of these ELSS, you can obviously add more to the compare section. There you can actually set a exact start date. So just add a few of these ELSS. Yeah, let's clear that list. So from here, if you just click those buttons, they are all getting added to the compare section. And when you go to the compare section, here you choose a custom start date. You say, okay, I only want to analyze everything from this date. And that date, you have to be careful that it doesn't go before the start date of any of these funds. So you can see the youngest fund, that's why we've given this age column also, is 9 years old. So don't put a date that's 12 years ago. Right, so it should be within the 9 years. Then you'll actually get a clear comparison. And here now you'll see the Sharpe and Sortino are calculated for that exact same period for all the 3 funds.
Yeah, no, so the point here was that, but obviously the Sharpe for all the funds will be different. But I was comparing it with the benchmark, and the benchmark, but obviously was different.
You can add the benchmark here as well in this compare section. So you have those 3, and you can just go on the top and select whatever you want.
Got it. Yeah, thanks.
That way you'll have everything in one place.
All right. No, here there is no problem, because that's put that I was under the impression that there is some issue with the data.
No, it should be fine, sir. It's been running for 4-5 years. We've had lots of tests and checks. So if there was anything wrong, we would have got it.
I don't know if you remember almost.
The very good thing about comparing SIPs versus point to point as lump sum. All right. Now, is there a way? I believe some schemes only allow SIPs and they do not allow lump sums. Is there a way to get this information from the NGEN report?
I don't think so. Prajakta, are you aware of any information we get about this?
No, specifically which do not allow SIPs but only allow lump sum. That is not evidently available as of now yet.
No.
But
Vice versa.
Yeah, okay.
Vice versa, because
Yes.
I think some schemes do not allow lump sum.
Oh,
They only
um,
allow SIPs, because if their AUM size is high
yeah.
and their market returns are high, some of our customers have said that they cannot do lump sum, they can do only SIPs. And I
Understand. So,
believe what my team has told me, that we have to go to each fund, and here where it I think it's mentioned deep inside whether we can do it or not. So would there be a possibility to get a report of who allows lump sum and who does not?
sure. What we can do is we can check with our data provider if this particular field is there. It's possible that if obviously if AMCs are releasing this information, it's possible that they do capture it. If they do capture it, then it's very easy for us to get into the system. And once it's in the system, then we can, obviously, then it's easy for us to give you a filter or something like that.
Something like
Right.
that.
Once the information is there, then we can present it to you in whichever form you want. That's the easy part for us. The hard part is always getting the data. So Prajakta, let's just make a note of that
Yes,
on
sir.
our list to find out whether this flag is there.
Yeah.
Okay. Thank you very much. I would have to leave this meeting. I got another meeting. I'm actually 16 minutes late already. Very good session.
Sorry about
and
that. Sorry about that.
no
Thank
problem. And Vikas,
Thank you so much.
very
Thank you so much, sir. Thank you so much, sir. Thank you.
Thank you. Thank you all. Thank you.